Today, I'll be breaking down Microsoft's fundamentals. I always start with 5 dimensions, a proprietary system where I dissect the fundamentals of a business. Let's kick off with the first dimension, growth. Microsoft's growth trajectory stands as a testament to its remarkable journey. Over the past decade, the company has witnessed an impressive 151.4% surge in revenue, boasting an annual average growth rate of 9.7%. From 2013 to 2017, Microsoft appeared stagnant, but under the leadership of Satya Nadella, it transformed into a cloud computing leader, trailing only Amazon's AWS. The first 5 years of analysis displayed an average yearly growth rate of 4%, whereas the subsequent 5 years witnessed a staggering 14% growth. Undoubtedly, an outstanding achievement. Similar patterns unfold across the other metrics within the first dimension. A period of stagnation prevailed until 2018, followed by robust growth. Now, let's shift gears to profitability dimension. Microsoft has maintained an impressive gross margin, averaging 66.5% of revenue over the past decade, and the current margin stands even higher at 69.4%. Operating margin has risen to 43% of the revenue, surpassing the 10-year average of 34.9%, showcasing Microsoft's enhanced efficiency over the years. However, the free cash flow margin has seen a slight dip to 24.4%, compared to the 10-year average of 26.8%. Remarkably, the return on invested capital has surged to an outstanding 34.6% from the 10-year average of 31.9%. Moving on to the solvency dimension. Microsoft's quick ratio, averaging 2.24 over the past decade, has declined to 1.64. Nonetheless, a strong value. The debt-to-equity ratio, which averaged 0.59, has further decreased to an even more favorable current value of 0.39. Net debt-to-EBITDA ratio demonstrates that Microsoft has more cash than debt, indicating ample liquidity. Lastly, the debt-to-free cash flow ratio indicates that Microsoft could pay off its debt with the cash flows it generates in 1.59 years, which is impressive. Now the important fourth dimension, valuation. The enterprise value to sales reveals a 10-year average of 8.85x, while the current multiple stands higher at 13.02x, implying a potential overvaluation. Similarly, the enterprise value to EBITDA multiple, which averaged 20.13x over the last 10 years, has surged to 26x, reinforcing the signal of potential overvaluation. Examining the price to free cash flow, the current multiple of 54x exceeds the 10-year average of 35x, once again signaling an overvaluation of Microsoft's stock. Lastly, the current value and the 10-year average of the price-to-earnings ratio are 37.6x and 34.3x, respectively. Despite the current value being closer to the 10-year average than the other multiples, it also implies a slight overvaluation of Microsoft's stock. The fifth and last dimension is the shareholders' return. Microsoft grew its dividends at an annual average growth rate of 9.8% over the last decade, resulting in an extraordinary total increase of 154.2% on its dividends. However, despite these remarkable dividend increases, the dividend yield averaged 1.4% over the last 10 years but has currently dropped to a lower level of 0.7%. The key metric of shares outstanding indicates that Microsoft has actively engaged in share buybacks over this 10-year period, leading to a decrease of 11.1% in the number of outstanding shares. To complete the 5D analysis, the payout ratio is currently at 38.0%. Microsoft's dividend is more than safe. Here are the ratings for the first dimension metrics and their average. The second dimension, profitability. The solvency dimension is rated as follows. The fourth dimension, valuation. And finally, these are the ratings for the fifth and last dimension. In this table, we have a summary of this section. The 5 dimensions final rating is a remarkable 3.4. Now let's move on to Microsoft's DCF valuation. I employ Wall Street analysts' free cash flow projections to compute Microsoft's fair value. The average estimates of the next 5 years are utilized for a base case scenario, the highest estimates for a bull case scenario, and the lowest estimates for a bear case scenario. The base case prices Microsoft's stock fair value at $459, 18.2% above the current stock price, which indicates that the stock is undervalued. The bull case prices Microsoft's stock fair value at $590, 51.9% above the current stock price, which indicates that the stock is undervalued. Finally, the bear case prices Microsoft's stock fair value at $290, 25.2% below the current stock price, which indicates that the stock is overvalued. In summary, Microsoft earns a solid 5D rating of 3.4, and its weighted average price target is $451, implies a 16.3% undervaluation. Putting all together, my final verdict is, next round, Analysis 2.0. Microsoft stands as an exemplary business, a behemoth, and according to analysts' free cash flow projections, Microsoft stock seems to be undervalued at the moment. That's why I'll move Microsoft's stock to Analysis 2.0 and perform a more comprehensive analysis on Microsoft's business and financial statements. Don't forget to subscribe to my channel and stay tuned for the next analyses.